Welcome to Fintech CTO Talks. On today's podcast, we will talk about how should financial institutions measure the value of AI. I am Ami, and in each episode, I sit down with CTOs, engineers, innovators who are making finance faster, smoother, and connected. The podcast that goes behind the scenes with tech leaders, solving the challenges and rewriting the codes. Money moves fast. Does fintech keep up? Let's find out. Today, Today's guest has been on both sides of the conversation. Sai Sharan Tangeda. I hope I have pronounced your surname correctly, Sai.
Yes, so that's why I've shortened it so that it's
He is the co-founder and CEO of Vishwa.ai, where he is building AI infrastructure for high stakes financial decisions. Vishwa.ai turns complex financial workflows into reliable, governed, and audit ready business outcomes for financial institutions. Sai brings a product led founder's perspective on practical AI, enterprise trust, and what it takes to build technology that institutions can rely on. We welcome you, Sai, to the podcast.
thank you. Great to be here.
So, my first question is speed is the most common AI sales claim in document in intensive finance. But faster isn't always better credit underwriting. That's what I think. So, how should institutions separate speed as a vanity metric from speed as a genuine risk adjusted value driver?
Right. So speed, I think, is called speed when it comes with auditability and consistency. So I think firstly, it should not be a vanity metric. Speed should be a genuine risk adjusted value driver, and that value should be measured against is the speed coming with any compromise in terms of auditability or the consistency in terms of delivering the output. If there is, then it is not speed, especially in a finance world.
So, how do the institutions separate it? If you could give us an example of it to make it more simple for the people who are just listening, have just
Right.
begun to listen.
So let's take a simple example. Let's assume that we are extracting a simple financial statement, a very basic workflow, right? So there are 10 companies that you're underwriting. So if AI is able to do this extraction in 15-20 minutes per document, that's good. But it's good when the extraction is giving you the same amount of consistency across the 10 companies. It is not good if it works for one company and definitely is degraded for the other companies. That is one side of the example. The other side of the example is, let's say you are computing the ratios. For example, a ratio like DSCR, which is very common in lending and credit, right? So if an agentic system is built in a way where how it's calculating the ratio is not clear, then although it is giving you the answer, if you upload the documents, it is giving you the answer. How can you be sure that it is 100% right? And as long as analysts are not sure, they end up checking everything. So is it really speed when you don't know how a metric has come to you, when there is no auditability? That's
Correct. So, most AI platforms for credit underwriting still require a human expert to verify every output, even today. So, if human review is mandatory, how do institutions measure the net productivity lift, and at what analyst headcount does the ROI math actually work?
so productivity lift is definitely, I mean, there are multiple drivers to it. The first one would be the time itself, right? So basically, if we want to identify, uh, let's assume that there is a 10-member analyst team.
Hmm.
Right? The 10-member analyst team was doing certain amount of task and they were spending, let's say, 50% of their time on data extraction. Now with AI in place, let's say they are able to spend only 10 minutes per the document and still extract it. That's definitely a productivity lift that is directly measurable. But the hidden cost that most of the people don't consider is when you buy a SaaS platform or when you build and host, right? There is a cost to it as well. So the AI platform brings on a cost which you have reduced in terms of the human time spent.
Hmm.
Now, if you add up both, that is that is your net new cost.
Hmm.
So now, as long as this net new cost is lower than your analyst headcount, then the math works, which is different in India versus US. So in India, the count is much lower, and in US, it is the ROI per analyst headcount is higher, right? But what I would propose is buy a solution which is not 95%. So let's say AI platform is 95%, some others claim 99%.
Hmm.
Any SaaS platform that is DIY tool, right? So if it's a DIY tool, then it is expected that you are still investing your time in identifying where the error is.
Hmm.
Oftentimes the errors are not clear, they are not evident. So you spend a lot of that time in identifying where it is and then fixing it. So the net ROI is not consistent here also. Again, the same point comes in where, okay, it is working in some place, it is not working. So how do you measure overall, right? So that is why I think buy somebody who is giving you outcome rather than 95% software. So for example, if we have to draw a parallel, let's take software's pre-AI era, right? They were, whenever somebody subscribed to them, they knew exactly what they were getting out of it. But now that value is not clear. When somebody is taking an enterprise AI, what is that AI SaaS platform committing, right? Is it 95% accuracy that they're committing? Then it is only 95% of the problem that they're solving. And
Hmm.
what is that 5%? How is that 5% changing? That is very variable and very nobody can quantify it, right? As much as they want to. So, which is why I think even we do outcome as a service. So basically, it's not like we just give you the software and you do it. We completely give you the outcome. Like if there are complete deal documents of a company, which are 20 documents, 30 documents are uploaded, all the documents, 100% accuracy, that is the process, right? That is a process that you're automating. So if you're automating, then it should be 100% accurate.
Okay. And you were like, you were saying that there is a difference in India and US. So what is that different? Like, how is it different and what is different?
So in obviously the pay scale matters here. The
Right.
software costs are similar, but the human pay scale in India versus US is different. So that is a big gap in terms of how the math works across geographies. But also apart from that, it is about, I mean, it is about like how much an organization is willing to invest in terms of long-term versus short-term gains. Sometimes ROI might not be clear in 1 month. It
Hmm.
might be clear after a year or two. So there, it depends more on the organizational DNA rather than the geography.
Okay. So what's the right control group, for measuring the AI value in private credit? Since you can't, just randomize trials into live deal flows. So how should institutions design a rigorous before, after, or, A versus B, the framework basically?
Right. So basically, if you have to evaluate an AI tool, the best way to do it is, I mean, you cannot do A/B because it takes a lot of time for you to even identify, and there are a lot of variables. The easier way would be you identify fixed set of cases that you have already underwritten before, where you
Mm.
have human generated artifacts, and then if AI is able to, so again, when I mention AI, it's not a single model that is completely automating the life cycle of an analyst. That is impossible right now.
Correct.
So there is physical due diligence, there are human inputs that are involved. But using AI, in lesser amount of time, if you're able to generate the same quality output, then that should be a measure of success with AI, because ultimately you have been able to achieve it with lesser dependency on you to do the repetitive tasks. So
Okay.
that would be easier way for people to de-risk than doing it on live.
Okay. So, when a financial institution sees 100 AI pitches a year, what is the single most powerful question to ask that separates a genuine value from a polished, demo? And why is show me your error rate on your document types so underused?
So one of our initial customer that we were pitching to about a year and a half ago, they asked me the same question, exact same question. I keep getting these pitches every month. Why should we give you a chance?
Correct.
So the answer that I gave then, which worked for us because now they are our customer, is so there are all these companies which are telling you that they'll do the same thing. But what you should evaluate is one, whether they can spend time with you, because what you are looking for is not a generic DIY single step automation. It is a process which is your credit policy that you are, or your investment thesis that you are trying to automate, which requires deep investment in terms of the vendor with your team to understand and incorporate, right? So that factor. The second aspect is anybody who is saying that I will provide this much accuracy, it is not something that is going to be easy for you to evaluate or keep them accountable, because you cannot keep monitoring a vendor or a AI platform throughout the year, right? And if it's going down accuracy, then who knows? So invest definitely filter that part out and only buy people who are saying that this is the value they'll give you and this is the amount of commitment that they can give you. So I think these both are definitely a game changers in 2026 from the SaaS era.
So, like, as you were saying, vendors pitch efficiency, few pitch auditability. So, how much should a regulated financial institution weight, explainability and audit trails, completeness versus the raw speed in its vendor scorecard? And how does the RBI Free AI framework help?
So I think RBI framework as well as in US, all the regulatory authorities are now very clear about this. Like, if you don't have auditability, if you don't have explainability, then what you have is not speed. Basically, that solution is a no-go. So I think that clears up for institutions as well who are adopting this, and for people who are investing in building solutions for these institutions as well, that this becomes a table stakes. Everything needs to be auditable. The exam readiness needs to be there in US, right? So
Okay. And when AI automatically extracts financial ratios, like the DSCR, the NOI, the cap rate, so who owns the model risk? The vendor, the institution, or the analyst who, approved the output? And how should governance framework be rewritten for AI assisted underwriting?
so there are two concepts, I think, which are very subtle but very different: responsibility and accountability. So I think regulatory requirements are very clear that responsibility needs to be and is ultimately with the financial institution at hand. But financial institutions should hold vendors and the involved people accountable. So each department, each vendor needs to be accountable for what they're delivering. So the accountability should be there in its place with its contingencies and the deal contract that they have signed up with. And the responsibility obviously still falls on the, as per regulation, on financial institution.
AI underwriting platforms, ingest, borrow financials, the bank statements, and rent rolls, some of the most sensitive data in the private markets. So,
Hmm.
beyond standard certifications like the SOC, the ISO 27001, what should institutions stress test in a vendor's data handling before granting access to the data?
So I think you might have heard of this concept called TPRM, third party risk management. So across the world, I think not only financial institutions but most of the well established companies, they have set up these set of questionnaires which not only follow the basic set of regulatory asks but also their own standard security protocols which are required and essential. So I think apart from these standard compliances, every vendor is expected to go through the TPRM, the third party risk management. As long as that is done, each institution is reliably testing and doing these audits regularly at a frequency. I think it should be good enough.
Okay. So the cross-document validation, catches discrepancies between balance sheets and audit reports. But sophisticated fraud often involves consistent misrepresentation across all documents. So what are the structural limits of document layer AI, and where must human judgment remain the last line of defense?
So you are saying that if the same mistake is cleverly present across all of the documents,
Yes,
then
yes.
how does this? So interesting question, I think, but so basically, it requires certain level of expertise to do that sort of thing. Like you have bank statements, financial statements, to ensure that things are consistently wrong and you are able to surface that way. It requires certain decently established setup and expertise in a different wrong sort of way to come up with that sort of thing. But even if they do, I think what breaks this pattern is there is physical due diligence.
Hmm.
So let's say you have done all the clever accounting that you can in wrong way, which you're not supposed to, and everything is consistent. No systemic identification has been done just from the documents. Then when you go to the person who is actually taking the credit or whom you are investing in, if they are a construction company, then when you go and investigate the projects that are there, the materialness of the projects once you are in the ground, the raw material that they have already procured, you will get a decent idea on whether they have projected wrong things or whether they are actually in the water.
Okay. There is a research commissioned by Google Cloud and conducted by the National Research Group across 556 global financial service leaders,
Hmm.
and that found that 77% report achieving positive AI ROI within the first year, yet Gartner simultaneously predicts 30% of generative AI projects. So, how do you explain that gap, and which number should a financial institution trust when building its business?
So, I think two researches are slightly independent, and the way in which they have the sample set that they have considered while they are coming for the outcome and how they are actually looking at it depends on the percentage and what they have come up with, right? So maybe that percentage itself should not be taken as anything too positive or too negative. But so see, I think because of AI, everybody is starting to one either be scared that somebody might fool somebody else,
Yes.
and or rather that somebody might not even provide the solution and is just claiming that they'll provide a solution.
Correct.
So simplest explanation and the answer to this is keep doing what you have done before. Like if you were evaluating an ERP solution before, what are the things that you would have done? You would have taken a POC, tried out the solution for a couple of days. If it is working, you would onboard, try to use it over a fixed period of time, then see your ROI. If it is there, then invest in long-term contracts. Same thing is valid now as well. As long as the tool is able to deliver the value, I would say AI is more and more becoming that models are becoming commodity, right? Like Claude has better model 1 month, and
Yes.
then ChatGPT triumphs that. Every sector has a different model of expertise. Open source models are competing, and then fine-tuned setups. So there is nothing that a simple AI as a model can do. Still, it is the software and what the software is providing to you. So I think financial institutions should stay in that still their comfort zone. Still look at it from their lens on if they buy anything, what are they getting? If they are clear on that, then go for it. Like no metric, positive or negative can influence that.
Okay. So like if AI enables, institutions to evaluate more deals in parallel without adding the headcount, what happens to the career trajectory of junior credit analysts, or how do institutions manage the talent and the cultural implications of that trade-off?
So basically, the career trajectory of a credit analyst, I think, is it's not going to go away for sure. And so private credit is increasing, right? It's compounding over the past years. We have seen immense amount of growth and CAGR. So I think number of credit analysts that are required to underwrite overall will be needed more and more as businesses keep growing. They'll keep needing more capital. Types of investments, the methods of investments are increasing. So in that way, the career trajectory is going up. But the way in which AI is catching up is AI is able to do most of the work which was busy work, right? Uh, and work that could lead to inconsistencies if the human was doing it alone.
Hmm.
So, like basically, there are 10 things to do and 10 resources to research. Let's say you have forgotten one resource and you have gotten the research from 9 other things. That is being now triumphed by AI, where it says that I have researched all of these 10 things,
Hmm.
and this is all the information that I could compile. Now your decision becomes simple. So,
Correct.
the way credit analysts could reposition themselves is not around what AI is doing or what AI can do, but rather their ability to make a decision from the consolidated research. So there will always be pros and cons in every deal that people will underwrite. Nothing like barely things will be so clear that okay, this is the best deal ever. There's no negative, right? Especially in mid market. I'm not talking about high enterprise where things are already clean. So in mid market, whenever these uncertainties are there, ultimately it's the credit committee and the analyst who is making the call. So they need to figure out how to make the right calls, which are balancing that risk and getting the reasonable outcome that they're expecting.
Okay. So an AI platform that enforces one fund's credit policies consistently across 1000 deals could also entrench existing biases or outdated credit models at scale. So, how should institutions audit whether their own policies are worth automating before they hand them to a machine?
So this actually we faced with uh, historically we have faced this as well. So
Okay,
whenever basically you have a policy, the policy is always good, right?
correct.
There is no problem with the policy. But when it comes to implementation, then it depends on the type of person and the type of environment
Exactly.
that they're working in, multitude of factors, which can result in the inconsistencies. But if rather all the deals are following the same level of consistency and there is a human in the loop who is checking, then if the mistake is same, the likeliness of it being caught is much higher and pretty easy. Rather than a person specific mistake, which could be, nobody knows whether you have researched this particular element or not. Your
Hmm.
output is ultimately your opinion, correct? That's what it is. So, but if 1,000 deals are following the same methodology, then if not one person, the other person can definitely catch the error, which the system could have made, and the policy correction happens much faster.
Okay,
And like orders of deals faster. If there was no system which was consistent, you would have probably not even known that such an inconsistency exists.
exactly.
So it's a feature, I would say, rather than bug.
Okay, okay.
Yes.
So there is another study by Bain and Company. There's a survey of 109 US financial services found that institutions with at least $5 billion in revenue are investing an average of $22 million a year in AI. That was back there in 2024. Like that is roughly 25% more than firms in other industries at the same revenue tier.
In 2024, what are
Yes.
they investing in?
They were investing, the Bain and Company surveys, it says that 109 US financial service firms found that institutions with at least 5 billion in revenue are investing in an average of 22 million in AI
Hmm, hmm,
in
hmm.
2024. So that is
Got
roughly 25%, right?
it.
The study says that. So if the average productivity gain is 20%,
Hmm.
so what happens to the 70% of the respondents report the talent gaps in the technical or the risk compliance functions? Is the industry investing in the right layer of the stack
So
or
if I'm
building faster cars, just without any drivers?
Hmm. So if I'm getting this right, you are saying that people are investing about 22 million in financial
Yes.
institutions as of 2024,
Hmm.
but most of them are saying that there are still talent gaps
Hmm.
and risk
Correct.
compliance
Correct.
in risk compliance functions. Okay, so I think so. AI as a co-pilot is so. Let's assume that there is an analyst with 2 years of experience and there is an analyst with 10 years of experience. So if AI Copilot can help the 2 year experienced analyst to do all the checks and make a decision in the same way as a 10-year experienced analyst, then that's a win. And that's also a way a technique talent gap can be merged with AI as a right tooling. Are we driving in terms of the articulation that you did it, building fast cars with no drivers? So see, there has to be an expert. So AI can, let's say, in the best case scenario, an AGI comes in and it's able to answer 80% of the world's problems across.
Hmm.
But world will still rely on the people in the specific domain who can get to 99% of that niche because it is still 80%, right? No, it is not 100%. So and I still cannot imagine where AI can be 100% of everything. I still think that is out of reach. So as long as that is there, fast cars with no drivers, driver has to be somewhere. As in either driver is owned by vendors who themselves ensure all of this quality is there. So driver is just repositioned, if you say, or it is there with the people with more higher expertise, but somebody will be there.
Good to hear that. Okay. So deep integration into analytic workflows, such a native word and Excel add-ins is often pitched as a differentiator, but it dramatically raises switching costs. So how should institutions evaluate the workflow embeddedness as a long-term risk, not just a short-term convenience or
Understood. So you are saying in terms of switching costs, as in like people are used to Excel now, everything is
yes,
also being done in Excel. So how do they move away from it?
yes.
So I think the AI platforms and the solutions, they need to democratize the application layer. Like for example, since Excel is being mentioned, I'll take Google Sheets as an
Hmm,
alternative. Whatever AI tools and copilots are being available in Excel should same be provided along with the Google Sheet as well.
hmm,
And the reason why embedding is essential right now is because people are trying to, so there are still a lot of institutions which don't or haven't yet gotten the taste of AI yet.
hmm,
And the change management is very hard if you also change the tool, right? Excel is a very powerful tool that analysts and finance folks across industry have been using for decades, right?
hmm.
Nearly half a century. So in that case, the comfort of them confidently adopting a tool comes in when you start with the place where they are already available. That is why we also focus heavily on the embeddings, integrations, so that
Correct.
it's easy for them to at least start getting the value and using it.
Okay. One last question, Sai. Beyond efficiency metrics, what does it mean for a financial institution to measure whether AI is actually making it smarter? Is there a framework for tracking decision qualities, not just beyond the speed or the spreadsheets or whatever we talked in the podcast today? And what do you see in the next 5 years as an investment horizon?
Uh, so efficiency metric in a 5 years for financial institution, you are saying?
Yes.
So for financial institution, I think the metric would be same. The bottom line is NPA, non-performing asset. So if over a 5 years investment period, like if you say NPAs are reducing, that means your system is getting better in the bottom line. And then the top line would be, let's say you are doing 100 deals an year right now. Is there a consistent rate of improvement over the span of 5 years with AI without increasing your head cost? So your human cost remains the same, and with just better tooling, you're able to scale and get more deals. That's an amazing success that you can get.
Perfect. We'll move on to the next segment of the podcast. That's the rapid fire round. I'll ask you a few questions and then you'll have to be very quick in answering.
Okay.
It's one word or max one sentence.
Okay, got it.
One AI buzzword you can happily ban.
It's agent.
Okay. Build versus buy versus partner. Pick one.
Partner.
AI in one word, overhyped or underestimated?
Definitely underestimate.
Absolutely. Pilot projects, necessary evil or biggest trap?
Necessary evil.
One metric CXO obsesses over but shouldn't.
Blind automation instead of whether it's actually bringing any decision value.
Okay. If AI were a cricket player, batter, bowler, or all rounder,
I think definitely all rounder.
who is your role model in the fintech industry?
Anybody who's, I think, still believes that finance runs on trust before it runs on technology, right?
We'll move on to the next segment, Sai. You'll have to answer one question into 30 seconds.
Right.
How should financial institutions measure the value of AI?
Right. So this is my co-founder Mohit usually calls it out in this way. So policy governance is a product, meaning a tool which is able to implement your policy and able to consistently do it across 1,000 deals, right? So that becomes a cement, a foundation for you to measure if an automated tool is able to provide the value and is replaceable at all for your institution, right? So I would say this becomes your new criteria to measure and at least have a baseline. On top of it, you have definitely the ROI that comes in, where how much are you getting in terms of the cost that you have spent, in terms of the top line, how many more deals are you able to evaluate because now the time to evaluate per deal has gone out, and also in terms of per analyst consistency, right? So let's say you have 15 analyst team. So and each analyst used to produce different level of output. The number of iterations it used to take in the investment committee were higher. With some analysts, with some other analysts, it was easier. So now because system is able to implement your policy across, so the number of iterations that you are doing per analyst is reducing, which means every analyst is able to produce like your top analyst, right? So these are all the levers that you can use to measure if AI is helping.
Perfect. Thank you, Sai, for joining us today and sharing wonderful insights on the topic.
Thank you. Thank you.
Perfect. So, everyone, let's stay connected for more understanding on finance and technology in the future. If you're building something in finance and want to explore ideas, strategy, or technology support, feel free to connect with us. Sai or I will definitely get back to you. Please share this episode with all the people who love finance and technology. We will meet in the next episode. Until then, stay curious, stay inspired, and keep exploring.